Why are Treasury yields suddenly becoming such a massive problem for stocks? Well, the answer to that might actually be sitting in the bond market rather than the stock market itself. Right now, we're seeing Treasury yields rising aggressively, and that upward momentum, it's putting some absolutely severe pressure on equity valuations across Wall Street. Because of this whole dynamic, the S&P 500 is currently sitting at a really critical technical crossroads. So in this explainer, we're going to dive strictly into the technical analysis and the macroeconomic data. We want to show you exactly how surging borrowing costs are completely reshaping stock market analysis right now. We'll break down the critical levels you need to be watching, and we'll unpack why this shifting relationship between the US dollar and Treasury bonds demands your immediate attention. Section 1. The Treasury Yield Threat. Okay, so to truly understand the downward pressure we're seeing in the stock market right now, we have to look at those surging borrowing costs. It's absolutely crucial to get this. The current pullback we're experiencing isn't really about bad corporate earnings, and it's not about some immediate economic failure. It is a direct mathematical reaction to rising interest rates. But let's take a step back. What actually is a Treasury yield? Well, simply put, it's the interest rate the U.S. government pays to borrow money. And that rate basically establishes the baseline for all other interest rates in the market. So when Treasury yields go up, the cost of borrowing goes up for literally everyone. Your mortgages, auto loans, those become more expensive for everyday consumers. But crucially for investing, higher yields drastically jack up the cost of capital for AI companies and those high-growth businesses that rely heavily on cheap financing to fuel their rapid expansion. When capital gets expensive, equity valuations get squeezed. Simple as that. So what's the fundamental fiscal root cause driving these yields so much higher? Well, look no further than our staggering $40 trillion U.S. national debt load. $40 trillion. The bond market is essentially reacting to the government's continued inability to rein in that rapidly expanding fiscal spending. As that mountain of debt grows, bond investors are naturally demanding higher interest rates to compensate for the risk of lending to a government carrying that much leverage. This specific dynamic is what's driving up the critical 10-year and 30-year Treasury yields, which, as you know, act basically like gravity for stock prices. To really put this into perspective and to illustrate the severity of our current macro environment, get this. The 10 and 30-year Treasury bonds are currently sitting at yield levels we haven't observed since 2007. Think about that, right before the global financial crisis. Now, to be clear, this doesn't mean a financial crisis is hitting tomorrow, but it gives us vital historical context for why the stock market is behaving so erratically lately. The era of 0% interest rates is definitively over, guys, and the market is violently repricing to adjust to this new reality. Section 2. S&P 500 Technical Crossroads. Let's pivot and look at exactly how this macro threat is manifesting on the broad stock market. The specific formation we're tracking right now on the S&P 500 is what we call a megaphone pattern. Now, unlike a standard wedge pattern where your trend lines converge and the price action tightens up, a megaphone pattern features diverging trend lines, meaning the trading range just keeps getting wider and wider over time. In technical analysis, those diverging trend lines tell us the market is experiencing increasingly erratic, violent price swings. We're seeing elevated market volatility as buyers and sellers fiercely battle for ultimate control. So the million-dollar question is knowing where the boundaries of this megaphone actually sit. Let's walk through these key zones. Your major resistance, basically the potential upside target if we happen to break that upper trend line, sits mathematically in the 8,100 to 8,200 zone. Immediate resistance is found right along the yellow upper trend line of the pattern, which has historically capped our price action. But pay attention, because the absolute most vital number on the board right now is our critical support at 7,350. A break below 7,350, that would signal major systemic issues and deep structural concerns for the broader market. Now remember, we always treat these as technical reference levels to help manage risk, not as guaranteed crystal ball predictions. Section 3. Fed versus bond market. Now, to truly understand where those S&P 500 levels might break, we have to examine the tug-of-war happening between the Federal Reserve and the bond market itself. See, most investors just hyper-focus on Federal Reserve announcements. They sit around waiting for Fed minutes to gauge the seriousness of dissenters who want to hike interest rates. But here's the absolutely critical systemic indicator. Market rates can and often do move completely independently of the Federal Reserve. Even if the Fed decides to sit on its hands and not hike rates, market yields are rising all on their own. The bond market reality is autonomously taking control of the pricing. And that suggests the bond market, rather than the central bank, is the true compass right now. Honestly, if you're investing based solely on what the Fed says and totally ignoring what Treasury bonds are actually doing, you're flying blind. Section 4. Dollar and yield divergence. This autonomous bond market leads us to a pretty rare and frankly alarming macro signal that's unfolding as we speak. Normally, rising interest rates make a currency more attractive, which naturally strengthens the US dollar. But currently, we're seeing rising yields alongside a weakening dollar. As our source analysis points out, quote, if we don't pay our bills, our interest rates go up. The same thing goes for the government. This divergence is a primary indicator of a systemic loss of confidence in the government's fiscal management and its long-term ability to handle that massive debt load we talked about earlier. This growing loss of confidence in the underlying currency system has been described in our source analysis as a, quote, slow-motion train wreck. It's like a wobbling train that hasn't exactly left the rails just yet, but it heavily hints at the possibility of a 100-year cycle crash scenario somewhere down the line. Now look, don't let this be an outright panic signal. That's not what we're doing here. Instead, use it as a very clear risk indicator to monitor. The combination of rising yields and a falling US dollar is simply telling you to be highly cautious and to strictly respect your technical support levels. If you're finding this market breakdown useful, take a second to subscribe to Fox of Wall Street, like this video, and share it with another investor who wants to understand what Treasury yields are doing to the stock market. Section 5. Key stock and asset levels. Okay, so now that we've mapped out the broader macro environment and the S&P 500, let's transition into the micro setup. We've got some rapid-fire, actionable technical levels for individual stocks derived right from the analysis. First up, equities. Baidu, ticker BIDU. It's facing some serious pressure from an earnings miss and the broader Chinese real estate bubble. But technically speaking, it's approaching a potential bounce area right around that $91 to $92 mark. Meanwhile, Home Depot's trading fractionally higher on earnings, but it faces significant technical resistance, hitting its head right at the $355 mark. And looking at the semiconductor space, following a pretty nasty sell-off lately, you want to keep a close eye on SanDisk and Micron for important downside support areas around $16.40 and $15.30. Flipping over to commodities, oil remains stubbornly range-bound within a wedge setup, and it's continually being pressured by those ongoing geopolitical tensions surrounding the Strait of Hormuz. Gold, on the other hand, is showing some really nice bullish consolidation. It's just quietly gathering upward momentum in the background. And silver? Silver offers a truly fascinating chart right now. It recently faced a major long-term trendline rejection, but it's potentially forming a bull flag setup right now, which could indicate a massive future breakout if it plays out. And of course, looking at crypto, specifically Bitcoin, following its recent massive breakout, Bitcoin is currently in a consolidation phase. Basically, it's just charging the battery. But to preserve that bullish upward energy, $64,000 is the absolutely critical observation level it needs to hold. If it loses 64K, the whole short-term thesis changes. And I'll say it again, guys, these are technical observations from the source material intended to be used for your risk management, not guaranteed financial forecasts. Section 6. The Investor Action Plan. Let's bring this all together. We're going to funnel all this macroeconomic data, the shifting Treasury yields, and these microcharts into a strict, bulleted action plan for Wall Street investors. Here is your concise checklist going forward. Number 1, watch Treasury yields. They are the gravity dictating the entire stock market right now. 2, monitor that dollar yield relationship as your early warning system for the fiscal health of the system. 3, carefully track the S&P 500 7350 critical support while simultaneously keeping an eye on that 8,100 to 8,200 potential upside zone. Next, expect and plan for market volatility rather than reacting emotionally to whatever the daily headlines say. Always use cold, hard, technical levels for your risk management. And above all else, avoid making investment decisions based purely on market hype and narratives. The ultimate takeaway here is that you have to prioritize technical analysis logic over the noise. So I'm going to leave you with this one thought. As that S&P megaphone pattern continues to widen out, will the bond market finally break the stock market's resilience? Or is this surging volatility just a violent detour on the way to 8,200? Mastering these specific technical levels is your key to surviving and profiting from whatever Wall Street throws at us next.